Hi, I'm Ben Reppond. Today is March 15, 2022. I want to begin with the Russia-Ukraine situation, its impact on the stock market. Before I get into that, I want to say this, that we see the images in the media of the atrocities in the Ukraine, the images of families, women, children, the bombing, the people escaping their homes, fleeing in many cases to Poland for refuge. And I don't want, by talking about the stock market, I don't want to trivialize what is behind it. So I want to make that very clear because I think it touches all of us. However, my job is investing in the stock market, and this is the driver of the stock market primarily right now. So to that extent, I want to cover this. So as I said, this is driving the market. There are other factors that are driving the market, which is inflation and China and what are they going to do with Taiwan. The uncertainty of the outcome of Russia-Ukraine is probably the fear that that could be worse is what is driving the market down or preventing the market from going up. And if it does go up, I think it'll go up temporarily and then it'll collapse back down as long as the news stays the same. If there is a broad-based effort to buy the market, the buyers of the large money sees that the out 6 to 9 months from now things are going to be okay. That looks like there's going to be resolution. Probably what will happen is the big money will come in and drive the market up. So there are two things that will happen. One is that will happen, that'll cause it to go up. The other is what is called exhaustion or capitulation, where the sellers just come in and throw in the towel. We are a long ways from when that typically happens. Usually the market is down 40 or 50% before those last people just say, I can't take it anymore, and then they sell exactly at the wrong time. So I want to point out that when the market is going down, it's in a downward trajectory, which it is right now, that what can happen is that it will at times, until it's done going down, it will at times try to go back up and then collapse. The sellers come in and push it down. And an example of that is that when you go back to 2008, I actually go all the way back to 2007, and you can see this chart that the market went down the S&P 500 went down 56% from its high in October to its of 2007 to the bottom in March of 2009. And it did that in what it looks like kind of waves. It would go down and then it would try to go back up and it couldn't. There was no momentum there. They were not done flushing the excess out of the market or out of the system. And so it would then collapse and it would try to go back up and then it would collapse. So it just kind of did this back and forth. And the attempts to go up, there's a term for it, it's called a relief rally. It's gone down and it needs to kind of let out a little steam and it goes back up. People try to drive it up, but it's not going to happen. So if we're in for a prolonged down market, usually what happens is, each time is a little different, but usually what happens is there will be the short-term bursts that will try to go up and then it will get pushed back down. So until we get to either capitulation or we get to positive news that will reestablish a long-term trend, my prediction is that's the way it will go. As we look out, we don't know how long this is going to last, but we do know that there's a lot of dark clouds on the horizon. There's a lot of trouble in the world, both economically, militarily, politically, etc. And Ray Dalio, who is the founder of Bridgewater Associates, which is the largest hedge fund in the U.S., famous investor. He said this recently: the times ahead will be radically different from anything we've experienced in our lifetimes. So the playbook that is happening now has not happened before. I'm going to get into some of the reasons behind that and the way portfolios are constructed, and I think his comment will make some sense. The famous investment manager, Jim Rogers, has said on two different occasions these things. The worst crash in our lifetime is coming, and the mother of all stock market crashes is on the horizon. We don't know, and Jim Rogers doesn't know when that's going to happen. We can speculate what might cause it, but we don't even really know that. But as we get to these uncertain times and the market starts to get shaken, these kind of phrases by well-respected investment managers and professionals start to make sense. And so when you look out, you'd say the risk is very high. What are the opportunities? What are the drivers that are going to push the market up and move back into a long-term sustained up growth market? We don't know. It looks like they are quite a ways away. And maybe what has to come first is what Jim Rogers is talking about, is the mother of all crashes. Maybe that has to come before we can get to that long-term sustained up market. I don't know, but there's a lot of excess in the system and prices are very elevated. And with risk that comes into the market, that can certainly be an influencer to push it down and keep it from going back up. I want to show you this website. It's called usdebtclock.org, and it shows it's a simulated showing you the rate at which debt is being accumulated in the U.S. You can see in the upper left, you see it says U.S. national debt, and it's 30 trillion and change. And it is moving. You can see how much that debt is going up every second. That's the amount of debt. Now let's go over to the right in green, the U.S. federal tax revenue. So the U.S. is taking in, just annually, taking in $4 trillion a year. This year, $4 trillion. Let's go back to the left, and we see that the U.S. federal, on the second line on the far left, let's go to the third line. The U.S. federal spending actual is kind of grayed out, and we're spending $6.8 trillion this year. To the right of that is the U.S. federal budget deficit. The actual deficit is $2.7 trillion. So there are four numbers. What is on the books, 30 trillion in debt. We're taking in 4 this year. We're spending 6.8, and we're left with a deficit of 2.7. That 2.7 gets added to the 30 trillion. What is going to bring down the market? It probably has something to do with debt. We have too much debt for the economy that debt is supposed to drive. If a company takes on debt, usually it's to grow the company, and they think that's a good trade-off. And so the debt to GDP, gross domestic product, that ratio of how much debt do we have relative to the economic output, the gross domestic product, is a ratio that determines, how healthy we are as a country. Dr. Ken Rogoff is the professor of public policy and economics at Harvard. He has his degrees from MIT and Yale, and is also the chief economist for the International Monetary Fund. Obviously a smart person, and certainly influencing a lot of policy with his connection to the International Monetary Fund. He's regarded as an expert in economics. What he says is that when a country has greater than 90% debt to GDP, a debt to GDP ratio higher than 90%, that country is going to have headwinds and a slow economic growth. He didn't say the market or the economy is going to crash or anything. It just gets to be unhealthy when a country goes above 90%. Nearly all countries are above 90%. Virtually, all of the developed countries are well above 90%. But I put these statistics here to show you how unhealthy the world is and how unhealthy we are as far as the amount of debt that we have taken on relative to our economic output. Japan, 682% debt to GDP. Europe, in total, 462%. UK, 478%, and the US, 345%. Every country has this ratio, but I just thought I would focus on those four numbers, just to show you how far above 90% we are. Now let's go over to inflation. So what we've been dealing with is the Treasury, the US government. Now we're going to go over to the banking system and the monetary system, which is money supply and inflation. This is the Federal Reserve. The Federal Reserve controls the flow of money. The flow of money is called M2. It's a term that they use to describe money supply. This goes back to 1959. I've shown this chart before, 1959 to present. I circled in red on the right the last 2 years. Since the pandemic in March of 2020 to today, that is the actual increase in the money supply. It was already headed up a lot, rising at a very fast rate. Now, the printing of money or releasing of digital money, however you want to say it, has accelerated at an astronomical pace. And you can see that where that is. The numbers on the left are hard to see, so I'll tell you what the number is. This is about $23 trillion. It has gone up 73 times. It's 73 times greater than it was in 1959. That's an annual increase on average in the money supply of about 7.1%. So what that tells you, using money supply as a gauge of inflation, is that inflation has gone up an average of 7.1% since 1959 in a period of 62, 63 years. And sometimes greater, sometimes less, but that's a good measure of inflation. Even though the industry, the financial planners, financial advisors, are all saying inflation over the long haul is 2 to 3%, that is not correct. The real number is about 7 to 7.1%. The Bureau of Labor Statistics, U.S. Commerce Department, publishes the CPI, Consumer Price Index, which they consider to be a measure of inflation, but it is not. It is not the real rate of inflation. It is an artificial number that has been contrived to try to keep it lower. What they have done in the CPI is they have excluded, they're very upfront about this, they've excluded food and energy. What is going up the most right now? food and energy. It's nice they want to exclude that, but the real number is not 7.9%. And you know this because you go to the pump and you buy gas, you go to the grocery store and you buy groceries. You know it's not 7.9% higher than it was last year. It just isn't. So the real rate of inflation is much higher. But you can see using their chart where it has come from just in a couple of years and where it has gone to. Imagine that that number is not 8% or 7.9, but it's actually double that. It is 16%, not 8% or 7.9. I've referenced this before, the website shadowstats.com, produced by John Williams, economist, and it's been published since 1980. And he tracks and documents the real rate of inflation when everything is added back in. In other words, there's no adjustments, nothing is taken out in order artificially to get it to be a lower number. The red line is published by the Bureau of Labor Statistics, which is a number they want you to believe is the rate of inflation, and the blue line is the actual rate of inflation. Today, at the very far right of the chart, the blue line is slightly over 16%. This means that the buying power of the dollar or the buying power of your income is 16% lower than it was a year ago, the buying power. That means dollars in savings accounts, which are earning next to nothing, have lost their buying power 16%. Wages have gone up 6% in a year compared to last year. 6%. But remember, inflation is they're showing it is at 7.9, but it's really at 16. This next chart converts that income of 6% increase to the rate of inflation. So what inflation has done is erode the buying power of those dollars. The worker gets on average a 6% increase in wages, but that 6% is eroded, and you can see the right of the chart how much it is eroded using the Bureau of Labor Statistics numbers. Using an inflation rate of 7.9, that is how diminished the buying power of those extra earned dollars are. If we used a 16% rate of inflation, those numbers would be through the bottom of the screen and probably down around the floor. So when people who are getting a pay increase or people who are on a fixed income are saying, it's harder and harder to make ends meet, I'm having to make changes when I shop. I'm doing the best I can to drive less because I have less, because of the cost of fuel, etc. Those are real. That's what's happening. So what you already know intuitively because you shop and you get gas is this is putting a chart to it. The Federal Reserve is expected to have rate increases this coming year. Bank of America has estimated that there will be 7. JP Morgan has said 9 by next March. The federal funds futures are right at about 7%, showing that most people, based on their buying of futures contracts, are saying they believe that there will actually be 7 increases this year. We don't know how many, but this is an indication that there are many increases coming, and the purpose of those increases is to slow the rate of inflation. Unfortunately, it doesn't come without consequences. The printing of all this extra money had unintended consequences. They knew what was going to happen, which was inflation. So they printed all the extra money, which I showed in the money supply chart, and then you saw the effect of inflation. It's going through the roof. That's why it's 16%, because all of that printed money had to go somewhere, diminishing the buying power of the dollar. Now they're going to put a Band-Aid on that and try to fix it with rate increases. They probably shouldn't have done it in the first place. But so the effect of the rate increases is going to be, so I'm going to say this now, you'll see it happen over the next year, a crashed economy. It has to happen. You don't put the brakes on that fast, that many times, without having a negative effect. We can go back to the late 70s or early 80s in particular, and we can see the effect that Paul Volcker had when the Fed did the same thing. It crashed the economy. And that I see the same thing happening. I don't know when, but it may be even a delayed effect. But at some point, those increases are going to put the brakes on the economy. And of course, with rate hikes, bond yields go with rate hikes, interest rate increases, and that's going to mean that bonds, which have already started to collapse, are going to collapse even more. I'll cover that later. Now let's go over to oil. So same thing, oil prices are going up and up and up a lot. On Friday, they were $130 a barrel. I'm sorry, I don't know what they are today, but they have gone up from $60 a barrel to $130. The impact that the oil prices have on the economy is illustrated in on the last bar on the right. The blue portion of the bar is capital expenditures, and the red portion of the bar is the contribution to gross domestic product, which means it is pulling down gross domestic product. It is having a headwind effect on the economy. The gold dot on the right, I put an arrow to it, is the net effect on the economy. So oil, high prices will have a net effect. So we've got two factors working against us. One is rate hikes, which is going to slow the economy, which is also going to, bond yields will track that, which means bond prices are going to come down, bond portfolios are going to come down, traditional portfolios are going to come down, and the economy is going to slow down. Perhaps, I don't know this for sure, perhaps there's going to be job losses, and perhaps there will be a correction in the real estate market. There are experts who are saying both of those things will happen. This is an example, this gives you some data on gas prices over the last year. A year ago, across the U.S., the average cost of gasoline was $2.85 per gallon. Obviously, some places more, some places less. Today, the average price in the U.S. is $4.33. That is a 51% increase in 1 year. But remember, the CPI number that the government has produced, telling you that the rate of inflation is 7.9%, does not include this. And of course, it doesn't include food prices either. But that's just an example of how distorted the government published data at whatever it is, how distorted it is. When I was thinking about this, I thought about we rely on trucks. We rely on the transportation industry to move goods throughout the country, and in particular to move food throughout the country. And I was thinking, if all you're doing is driving a truck, that's your job, what does this effect have on you, have on these truckers? So I did some calculations, and I came up with these numbers. Hopefully they're accurate. The average truck, or the trucks on average, drive 100,000 miles per year. That's all they do is truckers drive 100,000 miles a year. The average mileage for a semi-truck, an 18-wheeler, is 6.5 miles per gallon. Not very good, but you see them, you can understand that. The diesel cost per gallon, not gas, gas is $4.33. The cost per gallon of diesel is $4.88 nationally. So I did a calculation, and that means on average that truckers are spending $75,000 a year on fuel. All they do is drive. Based on the size of a typical average tank or tanks in a diesel rig, 18-wheeler, this means that it will cost about $1,000 to fill up your tank. Imagine that. You're driving a truck. That's all you do. And so you're pulling into gas stations all the time. I've given you a picture of one. And you know that when you fill it up, you're going to get about $1,000 bill over and over again, and then get to $75,000 a year. So what is that? Who pays for that? Well, most of the time, you and I pay for that, because that gets passed on to the consumer, gets passed on to the retailer, it gets passed on to everybody. You know, the farmer, the processor, the warehouse, the retailer, and to you and me. We're all paying it. So, but there are trucks taking food, in this case, from the farmer to the processor, to the warehouse, to the retailer. And so those prices we pay for them. Or in some cases, I imagine the truckers are having to bear some of this expense, that their contracts may not have accommodated for all of the increases. So I don't want to speculate in that. I'm just giving you an example. There are about 2 million trucks on the road in the U.S. And by the way, it is reported that we are about 80,000 truckers short. If 80,000 truckers said, I want to work tomorrow and were qualified, they could get a job. In Europe, Germany is about 80,000 short. All of Europe, the EU, is 400,000 truckers short. But we have 2 million. This means at $75,000 per truck per year, or this year, this means an expense of about $150 billion being spent in our economy on fuel for those trucks. There are other expenses for the trucks. I was just focusing on fuel. Over to Europe, I want to show you a couple of European slides. I normally don't do this, but because there's a lot happening in Europe right now, I thought I would point out what's happening to the bond market. The bond market in Austria, for example, has collapsed 50%. What does that tell you? It tells you interest rates have skyrocketed. The Czech Republic is reporting inflation at 11%. So I don't know if they manipulate their numbers to exclude food and energy like we do, or if that's the actual rate of inflation. But you can see relative to what it was, just what has happened in the last year or so. Skyrocketing inflation and skyrocketing interest rates all over the place. So yes, the bond market is not only collapsing here, it is also collapsing in other parts of the world, and in this case, Europe. Okay, let's jump over to the stock market. This is a picture of the 6 major indexes that I track. The Dow Jones on the left side of the screen, Dow Jones, ETF is DIA, S&P is SPY, IWM is the small cap index, the Russell 2000, and two foreign exchange ETFs One is EFA, which is the developed countries, EEM, which is the emerging markets, and QQQ, back to the US, the NASDAQ 100. The reason I put a yellow box around QQQ, the NASDAQ 100, is it is worse than all of the other US indexes and is worse than the foreign markets, even the underdeveloped countries. It is down a lot. I think the last time I looked, it is down around 20%, but there are tech companies in that index which are down even more. I saw where Netflix was down over 60%. Facebook has been down about 50%. There's many of them that are down between 20 and 30%. This is the index that was the best index for 2021. It was outperforming all other indexes. And it typically is a very strong growth index. But what happens in periods like this, it has definitely happened, is that it has hit the NASDAQ 100 and particularly has hit growth stocks for this year, and it actually goes back into November and December. But when these indexes are measured where they are relative to this is where you get to the red dots on the right side, their 20-day, 50-day, 100-day, and 200-day moving averages, they are all below those averages. And that is definitely a negative sign and a bearish sign. That can change, but for now, and I showed you this last week, same picture last week. It is definitely moving in a southward direction. When we look at the S&P 500 on a weekly chart, meaning that every move here represents 1 week for the past year, we see that for going back into December for the S&P 500, that the direction that it has gone, it's continuing to drop. And how far down will it go? We don't know. Relative to its 20 period moving average, you can see it has broken through that and is continuing to head in a downward direction. Then I do a ratio, a comparison of growth stocks or growth stock index to the S&P 500. The growth stock index that I'm using is the Vanguard Fund VUG. It's an ETF. And VUG relative to SPY for the S&P 500, look where it has gone since November. So we talked about the NASDAQ 100, QQQ. That is also a growth stock index, and how negative it is relative to all other indexes in the U.S. and in the world. And compared even to the S&P 500, you can see how bad it is. If it had gone, whether it goes up or down, this is a relative chart. So if the S&P 500 dropped substantially and the NASDAQ 100 dropped just as much, the same amount, that line would go across the screen, because relative to each other, they would be the same, whether they went up or down. But it is this much worse than the S&P 500. Small caps, IWM is the ETF, compared to the S&P 500 for about a year. The S&P 500 index has been below, most of the time, below its 20-period moving average. At the end, I circle that because at the end, while it is not going up, it is still negative, but relative to the S&P 500, it is down less. So on a relative chart, it looks like it's going up. The Government bond ETF, the long-term government bond ETF, is TLT. The direction of TLT, the government bond exchange traded fund, moves in an opposite direction from interest rates. If interest rates go up, in general, that ETF goes down, and vice versa. So you can see, this is a 2-year chart, a weekly chart for 2 years, you can see the direction that it is going. 2 periods of time where it went down. There was a short period of time in between where it went back up, and that can happen, both with stocks and in bonds. But as soon as it goes up, eventually the pressure to raise interest rates pushes it back down. And this is where it is right now. Again, no matter if stocks are up today or down today, this is down. It's moving in a downward direction. And this is not good for traditional portfolios and traditional financial advisors who believe that this is in those portfolios to protect them against downside equity or stock risk. This is not doing a very good job of protection. I want to show you some charts from Asbury Research. These are internal market metrics. They use 6 of them to measure the internals of the market. Rate of change, relative performance to stocks versus high yield bonds, asset flows, corporate bond spreads, trading volume, and market breadth. These are technical terms, but they're measurements, they're metrics of the internals of the stock market. All of those are negative. Sector, exchange traded fund asset flows. This shows you the 2 worst and the 2 best for each of the time periods measured. The middle column is weekly. So for the last week, this shows kind of where the money is going. Now, this is not the direction of the ETF or the market. This is the flow of money, flow of assets, either into those ETFs or out of those ETFs. The ones that had the most positive flow of money in were definitely energy, and that is still happening, and healthcare. Now, healthcare is not going up. It is just going down less. But relative to the others, it's the second best, energy being the best. The money flow out of ETFs, the ones that are where money is exiting, probably a function of interest rates, are financials and technology. No surprise on technology because of what we just covered in the charts, the growth chart versus the S&P previously. This is a asset relative performance. This is comparing this type of asset with that type of asset. In all of these cases, they are all down. They are all going in a downward direction. So when something is green and looks like it is doing better, in every case, the word better is relative. What that means is it is doing less worse. Examples, U.S. stocks or bonds. Bonds are doing better, but bonds are doing terrible. They're just going down less than stocks are. High beta or volatility stocks, low volatility stocks. Low volatility stocks are doing better in most cases. Large cap or small cap. As we saw from a previous slide, small cap is starting to do better than large cap. S&P 500, the broad market versus the blue chips. The blue chips, the Dow industrials, are doing better and have been for some time. S&P 500, the broad market, or the NASDAQ, of course, the broad market, the S&P is going to be doing better. Growth or value, we've looked at growth stocks. We know that they're doing horribly. So value stocks, while they're going down less. U.S. or developed markets, mostly the U.S. is doing better. And U.S. or emerging markets, mostly the U.S. is doing better, using the S&P 500 as a surrogate for the U.S. markets. When you get to fixed income or bonds, government bonds are going down less than corporate bonds are. High yield is going down less than corporate bonds, and short-term are going down less than long-term bonds. U.S. versus the world. Last week we had John Kozar on the show, and he was pointing this chart out and saying, I thought it was a very interesting observation where he said that the markets around the world, of these 24 markets around the world, that the ones that seemed to be doing best, this was last week, seemed to be doing best were those that were farthest away from the Ukraine. And those were primarily Asia Pacific, which would be, say, Korea and Japan and Australia, and then South America. But this shows this week in the second column. That's the yellow at the top, weekly. That's the last week. You can see it's mixed. There are, and now we're starting to getting some, from a standpoint of a market, we're starting to see some bringing in of European countries in. I think that's interesting. And of course, still those that are furthest away from Ukraine are getting the heaviest, are performing the best. And then over in the last month, in the last quarter, it's mixed. The best ones are not the U.S., but the U.S. compared to some others are doing slightly better. Interesting comparison. Gold and silver, as of March 14, price of gold, 1962, down slightly from a week ago. Silver is now starting to emerge more. Gold was doing better than silver. Now silver is doing better, up 3.3% from a week ago. Of the assets that are doing well in the U.S., energy, commodities, and precious metals are doing the best. Warren Buffett said, "You don't need to be a rocket scientist. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ. Well said. It is not about raw intelligence. Investing is about having a strategy that works in all market conditions, my opinion, and works consistently as much as possible in all market conditions, and the investor who has the discipline to stay with a system or a methodology, a strategy, if you will, in all market conditions. In my opinion, that is the one that wins in the long run." I want to show you a book. This is a book that I'm reading right now, and you may say, "Ben, why are you showing this?" Bear with me. I think you'll see why I'm bringing this up. The author, Michael Greger, is a medical doctor. When he was a child, he saw his grandmother, who he loved, at the age of 65, say that she was dying. She had gone to the doctors. They had done everything they could for her. She had terminal heart disease. And they said, "Go home, put your affairs in order, because you have weeks to live." Michael Greger remembered that as a child. And as he grew up, the story of his grandmother caused him to want to go to medical school. She decided she had nothing to lose, so she went to a wellness center. And there, they didn't tell her what the doctors told her, that she had weeks to live. They told her that life is possible. but you will need to change your eating habits and your lifestyle. You will need to do some exercise, just modest exercise, nothing strenuous, and you will need to eat different foods because it is the foods you are eating mostly that are killing you. And she wasn't eating bags of potato chips every day, I suspect. She just wasn't eating the healthiest. So they taught her how to eat healthy and how to engage in some modest exercise. And within 3 weeks, she was walking 10 miles a day. Contrast that with 3 weeks earlier when they wheeled her in to the wellness center in a wheelchair. And that inspired Michael Greger to go to medical school. He was admitted, I believe he said, to 20 different medical schools, so he could go almost anywhere he wanted to go. But he picked the medical school that had the most emphasis on nutrition. None of them had much of an emphasis at all on nutrition, and even the one he went to had less than 1% of their curriculum on nutrition. Some had none. They taught them nothing about that. They taught them how to dispense pills and to treat symptoms, not deal with the cause of whatever the disease was. So the book is about his journey and about medical science behind the 15 leading killers of Americans, starting with heart disease and cancer and lungs, all the way down. And he takes each of those and deals with what can be done to prevent those diseases or reverse them. It's a very interesting book. The reason it made sense to me was because 11 months ago, on April the 17th, I made a decision to change my diet and my lifestyle. And I'd been eating a typical American diet. I didn't think it was horrible, but maybe it wasn't very good. But I decided to change it. I was motivated, like he was, by the story of somebody who told me how this had made a big change in their lives. And so I changed. The first thing I did was I got rid of sugar. That was the most impactful thing I heard about that story, was eliminate sugar from your diet. Well, it turns out I was eating a lot of stuff and drinking a lot of stuff that had sugar in it. I hate to admit it, but that was true. And I had inflammation in my joints. I had lack of flexibility, lower energy, etc. So I got rid of sugar. The next thing I did, about a week later, I watched a documentary and it had a big impact on me again. And I decided to go to plant-based diet. And that was radical, but not as radical as sugar. And the third thing I decided to do is to get up off the couch and go do something. So I started getting on the treadmill, just walking for 30 minutes a day, a brisk walk, but doing that for 30 minutes. Well, I increased that eventually to an hour a day, and now I'm including some jogging with it. But it doesn't have to be any more than just walking briskly for 30 minutes a day. That's what Dr. Greger says. But those three things, I lost 30 pounds within a few months. I increased my energy, my inflammation went down, and I just felt a lot better. And you can say those were simple changes, but in a way they were more than simple. It was not hard to do, but I had to be very determined and very goal-oriented and stay with my commitment in order to keep that weight off, and in order to have this, to feel better and have a healthier lifestyle. I hope, and I've said this before, my goal is to live to be 100 and to be healthy at 100, healthy and vital with energy. And when I get there, I'll figure out another goal. But I don't control how long I live. The Bible says in Job that God has numbered our days. So I know that. So I'm not trying to control my days and say I'm going to live to 100, but I'm going to give him some good material to work with. That's my goal. And hopefully I can live a long time. But I thought it was amazing that Michael Greger's grandmother went from being given weeks to live and actually lived to age 96. She lived 31 more years. The story behind this, for me, is that traditional medicine deals with the wrong issue. They deal with symptoms. They dispense pills to fix everything. And guess what? We, as consumers, have learned to rely on that. Just give me an easy fix. Just give me this. Well, it doesn't work. People still die. People still get sick. People still are disabled. We are among the sickest nations in the world. I think I saw a number that we're 28th in the world, and we spend far more than many other nations on sickness. And the book points out it doesn't have to be that way. We can focus on living a healthy lifestyle and eating properly. And if you're not motivated to do that, I'm not trying to change your opinion. If you're in the medical profession, I hope I haven't offended you. But if you are motivated or interested in that, hopefully this might be of help. And you can also call me and I'll be glad to talk to you about my journey. The thing that was interesting about this is I thought about the financial industry. It's the same thing. The industry I'm in is the same thing as the medical industry. It is surrounded by professionals who are caught up in conventional thinking. This is just the way we do it. We've been trained to do this, and those people were trained to do this, and those people were trained to do this by previous generations who have said the same thing over and over, and it doesn't work. It doesn't work well. And people get frustrated. I talk to people a lot who have been with other financial advisors, or they've tried this method or that method, and they don't work. And they get frustrated. They get frustrated at anemic rates of return, and then when periods of risk hit, their portfolios collapse. They're just frustrated. And I think like a lot of people who deal with medical professionals, same thing, is many of them are treating the symptoms. The results are not very attractive. And so it's odd that someone has to go to a wellness center and deal with a nutritionist and an exercise expert to live 31 years when the doctor told her she had weeks to live. The doctor who has all of this medical training failed at telling her how to deal with her problem. The book documents this. I recommend if you buy the book that you definitely read the preface and introduction because they set the context for the rest of the book. A few weeks ago, maybe it was a few months ago, I showed you this, and I want to say it again, and I'm going to close with this. It is so apropos, it so fits today more than it fit, a month or two ago. I have to say it again. Med Jones, I developed a friendship with Med Jones. He's an economist, and he is very smart. He focuses on economic issues. He is not a financial person. He's not licensed as a financial person. And he invests his own money, but he has a methodology to detect risks in the market and make changes in his portfolio. He does it himself, make changes in his portfolio based on the changes that he sees. I found him because I Googled the words, "Who got it right?" in 2008, and his name came up. And that's when I began reading more about him. And so he predicted at the very top of the market in 2007 that there was risk, a lot of risk coming into the market, and he got out of the market. He also got back into the market in March of 2009. when the market took off. I don't know what his methodology is. He's not an investment professional, but he has been very successful at detecting risk and opportunity in a way that the industry ignored all of this. He wrote this after 2008, and I thought it just says so much, and it tells a lot about the industry and his observation of the industry. So this relates, I would say, to at least the medical profession and the investment industry. I'll read this, bear with me. There are two main reasons that caused mainstream economists and financial media to miss the financial crisis of 2008. The first is the NIH, not invented here bias, which is an organizational phenomenon manifested as an unwillingness to adopt an idea because it originates from unknown outsiders. In other words, I didn't think of it myself. It is a form of social cognition bias that leads to errors in group judgments, such as missing on new opportunities or risks. The second reason is a cognition bias known as the confirmation bias, which is the tendency to search for, filter in, or interpret information in a way that confirms existing preconceptions. The confirmation bias is recognized as an individual cognition bias, but when met with NIH bias, it appears to develop into a social bias very similar to the groupthink syndrome. And that's what I see in the financial industry is a lot of groupthink. And I also see it in the medical profession, a lot of groupthink. If you have questions or comments, leave them in the comment section below. As I said, if you want to talk about this lifestyle and eating change that I did or that you're thinking about doing or that you have done, feel free to contact me. I'd love to talk to you about it. And thank you for watching.